This week on Bullshift, the podcast, I speak with Anna Malazhavaya. Anna is a tax lawyer at Advotax Law, and she has got lots of thoughts about what we might be in for with regard to the federal budget proposal for an inclusion rate increase that will be affecting some of us. You won't want to miss it. Stay tuned. Welcome to Bullshift, the podcast. This is the podcast where we talk about how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I'm the host of the podcast and the author of the book, Bullshift. My guest this week is Anna Malazhavaya. Anna is a lawyer with Advotax Law, a boutique tax law firm that helps you to solve your financial problems if you have tax problems and to head them off at the pass before you get them, if at all possible. Anna, welcome.
Thank you for having me, John.
You wrote a fantastic article in the Saturday Globe and Mail a few weeks ago, which did a really good job of summarizing the differences between the capital gains inclusion rate that's been proposed in the most recent federal budget, depending on whether the tax hike is realized, the inclusion is realized personally or corporately or for an individual or for a couple. In very broad brushstrokes, can you walk us through those differences and maybe use some examples, accepting let's assume that we're in the top bracket, which in Ontario was 53.5%.
Okay, so as you know, in this year's federal budget, the most talked about proposal is the increase in so-called inclusion rate for capital gains. So right now, the current capital gain inclusion rate is 50%. That means, let's say, if you bought an investment property for $200,000 and you sold it for $300,000, you realized $300,000 of gain. One half of it is included in your income and is subject to tax. So that's why we call it capital gain inclusion rates. Half of your actual gain is added to your income and subject to tax. In my article, I looked at different scenarios, case studies. I looked at the person who holds an investment property personally and his tax liability. I looked at a couple who held an investment property jointly and their tax liability. And I also looked at a person who held an investment property through a corporation because he wanted that additional limited liability protection and that person's tax liability. So although all these people, taxpayers in my example, they all had identical income, they all had identical ability to pay, even though they made equal amount of money on their investment properties, just the way they held the property, i.e. sole owner, joint owner, or through a corporation, just that alone had a serious effect on their tax liability. So the biggest winner in this analysis was the person who held the property with their spouse jointly, which they did just by accident because maybe their mortgage broker said, put your wife on title so it's easier to get mortgage. Now, in the middle, we had a person who is the sole owner. He would pay a bit more tax under the proposed rules. And the biggest loser in this case study was the person who chose to hold the property through a corporation because he wanted to have additional limited liability protection. So that person's tax liability will be significantly higher. So in that example, the couple was not affected by the proposed rules at all. The sole owner was affected, not to a large extent. And the person who held the property through a corporation really saw his tax bill increase dramatically, seriously. And I also considered different examples of people who move away from Canada and the implications, and people who pass away and leave their estate to their loved ones, what the implications of that. So it's kind of a before and after analysis using specific examples. Your tax bill would be X before June 25th and Y after 25th, and this is why. So that was
Right.
the
So that's the important thing, is that people listening need to understand that June 24th, 25th is the Rubicon that you're crossing, that the lower tax inclusion rate, current tax inclusion rate remains in effect until June 24th. And then the higher inclusion rate, if you're affected, kicks in midnight on the 25th. A couple of things that you didn't mention yet that I think are worth noting is that this is for individuals, but the higher inclusion rate is also applied in all cases for corporations and for trusts. So if you're a corporation or a trust, it doesn't matter what your income is, it doesn't matter anything, you're a corporation or a trust, and going forward after starting on June 25th, you're paying the higher inclusion rate. Could I ask you, and forgive me for asking what I think might be for you almost too simple of a question, but could I ask you to walk through the idea of marginal tax rates? Because some people listening, we talk about 53.5% being the top marginal rate in Ontario, but really you have to earn about $250,000, just maybe $240,000 to be paying tax at that level on the last dollar you earn. Can you just walk us through the idea of what marginal tax rates are so that people can get a sense of what that means?
The idea behind marginal tax rates is that people should be paying tax based on their ability to pay. We think that it's fair for people who have very modest income to pay very little tax, or maybe no tax at all, or maybe they need support from the government. And we think that people with high income maybe should, share a bit more of their earnings to contribute to the society. That the principle is the basis of our tax system. Therefore, the marginal rates are there to allow this to happen. So the act includes certain so-called tax brackets. When you earn a certain amount of income up to a certain amount, you're subject to lower tax rate. Every dollar earned above that first threshold is now would be subject to a higher threshold, to a higher tax rate. And you're right, our top marginal rate in Ontario, I was thinking it was closer to 54%.
53.53 is my understanding.
Okay. Well, I'm as I don't file tax returns, I don't follow this. My general assumption is around 54%. So that's the rate you pay on income in excess of, I believe, 250,000, right?
It's maybe a little bit lower, maybe 240.
240.
It was set at 200 when the Liberals came to power in 2015, and it's been indexed ever since. I think we're now at around 240 is where you start kicking into the higher rate.
That's correct.
Yeah.
So let's say if you make $300,000 a year, it doesn't mean that the entire 300,000 will be subject to 54%. It means that only your earnings in excess of $240,000 will be subject to the highest marginal rate.
So another way of explaining this is you've got different tiers, and you're paying no tax on the first 15,000, and then low amount on between 15,001 and 55, and then a higher rate from 55 to 120, and then a higher rate still from 120 to 240, and then over 240 is the highest. So what you get is, depending on where your income is, you pay what's called an effective tax rate, which is a blend of a little bit of this the first 15,000 was zero, and then it's a certain lower percent on the next amount, and then so that when you get to a certain level, it's a blend. And as you said, once you're over 240, that's the only the people that are making over 240 are paying that last amount, which is really only about 1% of the population. I'm wondering if you can comment, because your firm is a corporation, so you're caught in this net personally. And I don't want you to go into your personal details, but in terms of what kind of money you make, but other people that are professionals like you that have professional corporations, What have they been doing and accepting that the enabling legislation hasn't even been passed into law yet, and we're only about a month away from the deadline? But are you speaking with other doctors, dentists, lawyers, accountants that have corporations and asking them what they're doing, if anything, to prepare for this coming deadline?
I'm not just talking to the professionals. I'm talking to people in different lines of businesses, people who have investment properties, people who have loved ones who are about to, unfortunately, pass away. And the reality of it is that if they pass away before June 25th, their kids will get 8% more than. It's a weird time,
Yeah.
and it doesn't get any easier in light of the fact that we don't have the rules.
Right.
We don't have the rules. We don't have the technical legislation to advise our clients. So when I'm approached and people ask me for help, I tell people I'm happy to help. I have ideas, I have structures, but just so you know, I'm planning in the dark. I don't have the rules. Whatever the legislation may be passed in the future may somehow affect what I have planned. So there's some discussion. There is also an opinion from very senior members of the tax community that people should do nothing. This is because the change that was proposed is so profound. The change would literally touch a lot of sections, a lot of concepts included in this book, the Income Tax Act. This is one of them. It's one of two parts. There is a second part like that. So for the government to efficiently implement the change, they would have to rewrite a big portion of these books, two of them. And a lot of people think it's just not realistic. It's not going to happen anytime soon. And the June 25th deadline is there, but in light of the fact that we don't have the rules and there is no reasonable prospect to see those rules soon, some practitioners say it's not going to happen. Don't do anything. There's no point of planning something we don't, planning around something we don't know. Some people still do implement plans, and it can be as simple as implementing different rollovers, triggering gain, transferring properties to family members. Thinking about land transfer tax that should trigger, thinking about corporate rollovers that may help. Thinking about when it comes to people who are close to the end of their life, it gets very tricky because all the normal planning tools that were available to us were tied to the 50% inclusion rate. And we don't know what to expect with going forward. So it's a very uncertain time, but I'll leave my complaining for the later portion of the podcast.
Let's talk, if we can, about two things. Number one, this affects relatively few people because most people are not earning those kinds of capital gains at any point, either through shares or through real estate. But I'll allow you to comment on that if you could. But the other thing is with regard to shares in particular, even if you do have $500,000 or $1 million worth of pregnant unrealized capital gains in your shares, you can probably plan around it by letting the air out of the balloon slowly, $230,000, $240,000 a year over 3, 4, 5 years, and never triggering the higher inclusion rate. So there are things that can cause people to, there are things that you don't even have to change your planning other than maybe changing the timing of what you were going to do, but you can still do what you were planning on doing all along, just in dribs and drabs instead of all at once.
I'm less worried about my clients who have their savings in an investment portfolio. You're right. Yeah. When you have control over when you can trigger the gain, you have all the freedom in the world. You're right. You can trigger just enough capital gain not to be subject to the higher rate, and you won't have to worry about the proposed rules. I do worry about people who are forced to trigger all gain at once, based on the form of an investment that they've chosen. I know a lot of people who've chosen to keep all their retirement savings in real estate. I just looked up the statistics for how the housing prices were increasing in Ontario, in British Columbia, in Quebec, even in a number of other provinces. The average gain over the last even 5-10 years is way more than 250,000. And if your investment, if your retirement savings are in this one rental property, and you are ready to retire, you don't get to sell it, in portions. You have to sell it in all at once. You trigger this gain, and your retirement fund may be 8% less than you hoped it would be because of the new tax. Now, the same considerations will apply to people who pass away, unfortunately. So again, I don't know if your listeners know, we have this rule that deems you to have disposed of all of your assets right before you die. Even though you're not selling your assets to anyone, the law says we deem you to have sold over your assets, and we want you to pay tax on the gain. And you don't get to pick. You don't get to die a little bit over a few years and trigger $240,000 of gain. You trigger all the gain at once, and that's when even holding an investment portfolio can affect you. And the same rules will apply to people who are moving away from Canada, who seems to become Canadian residents. I guess policymakers are less concerned about those people, but these people are also affected. So the so-called departure tax will go up 8% on June 25th. On amounts over $250,000. So that's the reality.
Let's see if we can just talk a little bit about something that some people are starting to talk about now, and there's some discussion about whether or not this will even be enacted, because we have the leader of the opposition saying that this is not even part of what's being voted on. My understanding is that the government wants to carve out the inclusion rate section of the budget as a separate piece of legislation to be voted on, because they want to get the opposition on the record as to whether they oppose it or support it. But at any rate, we haven't had the vote. The deadline is only a little over a month away, and we still don't know. Do you think there's any concern? Well, obviously there's concern because we don't know. We're sort of making plans in the dark. But do you think there's even a chance that it will never see the light of day? I mean, we've got this confidence and supply agreement. I would expect that it would be enacted eventually.
I don't have any insider information. All I can share is the general frustration that we all feel in the tax community, and it's been building up. Again, I will start complaining. You may remember the story with underused housing tax, when a set of rules was enacted. A deadline was set for the taxpayers to file their returns. The rules were unnecessarily wide. People spent a lot of time and money trying to comply with the rules, only to hear a day before the deadline that they don't have to comply with the rules anymore. And the rules, the scope of the rules has been narrowed substantially. Just after we got over that situation, we dealt with a bare trust requirement. I don't know how familiar you were with those. When people were trying to figure out what they are and whether or not they have to file a tax return for a little savings account they have with their grandmother. And there was a study done that an estimated $1 billion was spent by Canadian taxpayers trying to comply with the Bear Trust requirements in time for the April 2nd deadline. And just, I think, over a week before the deadline, an announcement was made that, oh, don't worry about the Bear Trust rules, which is an active law, mind you. It's in the Act. It was enacted. The government said, don't worry about it. Don't file your returns. We'll have to think about it. So on that trend, if you ask me if there's a chance that the rules will never see the light of day or will be enacted but then retracted somehow, before I would have been surprised. But given the history of things that are happening, I won't be surprised.
Good to know. All right. So that brings us to That's Bullshit. If it was up to you, Anna, what would you complain about with regard to the way we're doing things in the financial services industry in Canada right now?
I would leave the wealthy alone for a while with never-ending tax hikes. And I'll tell you why. We live in a digital remote world, especially after COVID. The most successful, highest earners, people who pay 54% tax now, are getting more and more fed up with never-ending tax hikes. They're getting more and more upset with the media painting them as evil investment bankers or evil wealthy or evil 1%. They're packing up and they're leaving Canada. In my almost 20 years of practice, until 3 years ago, I never had to assist anyone to a wealthy Canadian who paid 54% tax before they left. I never had to assist anyone to leave Canada. I think I am on my 5th client this year alone who is packing up and wants to leave. And mind you, these are generally very successful, very, wealthy people who really contribute to the community, people who pay taxes, but they know they can make their money and work from anywhere in the world, and they're leaving Canada, and it hurts to see.
So I guess that was both That's Bullshit and A Shift Happens, because you've said what the problem is, and you've proposed the solution at the same time by saying just put an end to it. Anna, thank you very much. It's been a pleasure. It's always fun speaking with you, and I want to wish you all the best going forward.
Thank you very much for having me.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.